Welcome to Anu's classroom. So, in this video also we are continuing with accounting for managers, and these series, okay, this accounting for managers series especially, I have crafted it in such a way that people who are from a non-commerce background, okay, it is for them. Okay, so people who are from commerce stream, maybe those who have completed their BCom or NCom or even BBA, they might find that most of these concepts, especially in the initial days, it is a bit repetitive. Okay, so please bear with me. In this video we are going to learn about assets, liabilities and capital. Okay, so before going into assets, liabilities and capital, let us recap the definition of accounting which we had studied in the last video. Okay, this is the AICPA definition for accounting, right? It is defining accounting as the art of recording, classifying and summarizing in a significant manner and in terms of money the transactions and events which are in part at least of financial character. Okay, that is nothing but the economic data and interpreting the results thereof. Okay, and from this definition we can understand that there are four major phases of accounting. First is the recording of these financial transactions or economic data. Okay, then comes classifying them, that is grouping into appropriate or similar blocks. Okay, classifying them. Then comes summarizing them, that is creation of reports. It could be profit and loss, it could be balance sheet, whatever it is, all the different reports, and interpreting those reports to finally make business decisions. So from this definition at least we came to know that accounting is the art of recording, classifying and summarizing transactions and events, right, which are having some financial characteristic, that is it involves money, that is what is meant. Okay, so what are these transactions and events, what are these events especially? Okay, these economic events, well, to define it, an economic event is an event that is consequential to a business entity. Okay, and therefore these kinds of transactions, okay, or these kinds of events are measurable in terms of monetary units. So an economic event is a business transaction or a business event that happens in a business which involves transaction of money, that is inflow or outflow of money. Like for example, the sales of goods or purchase of materials, acquisition of plant and machinery, all these transactions, right? Payment of rent or amassment of a capital, all these things, they all have money involved in them, and therefore these are all economic events and we will record these in our books of accounts. Now, what are books of accounts? We will come to that later on in another video, but for now I hope that this concept of economic events is clear to you. Now, the next important concept is the concept of assets. Okay, what is an asset? An asset is a resource, okay, with an economic value that an individual or a corporation or a country owns. This is a very important part. Okay, either it owns or it controls, okay, with the expectation that it will provide a future benefit. Okay, so that is an asset. So this term, okay, for something to be called as an asset to you, okay, either you should own it or you should have a controlling authority over it and it should provide you a future benefit, okay, in terms of money, that is it should have an economic value. So in that regard, okay, let us take the example of let's say a piece of land. Okay, to acquire that land you must have given some money, right? So that land has some sort of an economic value, right? If you sell that land also you will get some amount of money, right? So land is a resource which has economic value. Now when you buy that land in your name, you own it, right? Or if that piece of land you got it as a hereditary right, then also you own it. Okay, otherwise if it is your ancestral property then you have rights over it, right? You have some sort of a control over that, right? So that is also fine. Now we own a piece of land, okay, without selling it. If you are holding that piece of land, it is The only reason is because we think that in the future it will give us much more benefit than its current value, right? So it is, we are expecting a future benefit from that land, either when we sell it, or maybe we'll do some agriculture in it, or maybe we'll build a shopping complex in it. Whatever it is, we expect future benefit from it. Therefore, a piece of land which we own can be termed as an asset to us. Okay, so that is an asset. So assets are reported on a company's balance sheet also, and they can be classified as current assets, fixed assets, financial and intangible assets, and they are brought or created to increase a firm's value or benefit the firm's operation. Assets are bought or created to increase a firm's value or benefit of the firm's operations. So assets can be thought of as something that in future will generate a cash flow. Okay, it will reduce an expense or improve sales, regardless of whether it's manufacturing equipment or a patent, whatever it is. Okay, so in that regard, let us take another example. What if you are going to buy a car? Okay, let us say that you're going to buy a car. Will it become an asset to you, or will it become a liability to you? Now, to understand that, we should also learn the concept of liability, right? But let us keep that aside. Let us think of it as a car. We are buying a car with just this understanding of what an asset is. Okay. So, in order for that car to become your asset, what are the requisites? Okay, when you buy a car, you definitely own it. You have given money to get that car, so money is involved. Okay, when you sell the car, definitely you will get some amount of money from it. Definitely, will you get more amount of money or less money? It might depend upon the model, right? If it is a antique model, if it is a rare model, then you might fetch a handsome amount of money over there. Or if it is not, then generally it has depreciation value, right? The money you will get when you sell the car would definitely be less than the money you would get when you buy money that would be gone from your pocket when you bought the car, correct? Now, so definitely it in the future it can generate the cash flow. Okay, but will it reduce your expense? If you are someone who travels a lot, okay, in that case it can reduce your expense, correct? But if you're not someone who travels a lot, will it reduce your expense? Because anyway you're not traveling much, okay, or it's just you, like yeah, so anyway you're not traveling much, then there is no significant reduction in your expense, right? Maybe you might spend 10 rupees if you are commuting through a bus, or maybe even 60 rupees if you are commuting through an auto to reach a certain place. Okay, that too you might be doing only once in a while. So for that small expense, okay, to eliminate that small expense, if you decide to buy a car worth of 5 lakh rupees, by the time you get back, and then again you need to do maintenance, you need to you need to pay for its insurance, you need to pay for its petrol, right? So after all these things that you will have to spend money on, apart from its road price, when you think of it, there is no significant reduction in your expense, right? But rather you have got more expense happening out of that car. So in that case, the car is not an asset. But in case you are a person who travels a lot, okay, or if it is a joint family and there is a lot of requirements for this particular vehicle over here, okay, then it could save you time and it could save you a lot of expense, right? It could, if you are a person who intends to use it as a taxi service, then it could even generate an income for you. After all these petrol and insurance and all these maintenance costs that are involved, you might actually get some revenue out of that car. So in that case, that your car is definitely an asset. Okay, so that, I hope the concept of asset is clear to you now. What are the different types of assets, right? So we told that assets can be classified into current assets, that is short term assets, right? Fixed assets, that is naturally long term or non current assets. Financial investments are also assets, like if you have an LIC policy or if you have an FD, that is also an asset. And then we also have intangible assets. Okay, so what are these different types of assets? Current assets are short term economic resources, okay, and they are short term in the sense, when we tell short term in accounting, we generally think of it as something which is less than 1 year. Okay, so short term is assumed to be less than 12 months. Okay, less than 1 year. Naturally, long term is more than 1 year. So current assets could be cash or cash equivalent, accounts receivable, inventory, and various other prepaid expenses and all. They are current assets. Suppose say somebody gifted you a gift card, okay, Amazon gift voucher, or maybe Mintra gift card, maybe even a Tanishq gift card, whatever it is, they got you a gift card. Now that gift card would be having a validity, and generally these gift cards expire by the end of 1 year. So such gift cards can be thought of as current assets. Okay. Then we have fixed assets, that is non-current assets. Okay. They have an expected life of greater than a year, like plants, equipments, and buildings. Suppose you bought a piece of jewelry. Okay. Then that would be a fixed asset unless you don't plan to sell it in the near term. Okay. Generally, when we buy jewelry, we think of it as a long-term asset, land. Okay. Unless you are a real estate agent who buys and sells land frequently, that is within a year, generally land is considered to be a fixed asset. And accounting adjustments are called depreciation is made for fixed assets as they age. So the concept of depreciation, we will touch upon it as we progress, okay, but just for your understanding, you can take the example of the car itself. Okay, maybe you bought the car at an on road price of say 6 lakhs. Okay, after year 1 year or 2 years, the car will not be worth 6 lakh rupees. Okay, its price will come down. Maybe it will become 5 lakh 50,000 or maybe even 5 lakhs, right? So as the years progress, the value will depreciate. Okay, so in books of accounts also, when we do the accounting for fixed assets, we do a small adjustment and we depreciate these value of these fixed assets as they age. Okay, so it is for what you can say, it is a convention or it is a practice that accountants do in order to give a realistic picture of the financial position of the businesses. Okay. Yeah, and then financial assets, as I said, it represents investment in assets and securities of other institutions. Okay, like stocks, sovereign bonds, or corporate bonds, preferred equity, hybrid securities, fixed deposits. All these things are financial assets. Then we have intangible assets. Okay, they are economic resources that do not have any particular physical presence. Okay, like patents, trademarks, copyrights, goodwill. These are things that have economic value, right? But they do not have a physical presence. And accounting for intangible assets generally differs a little bit dip, uh, depending upon the type of the asset from a tangible asset. Okay. Then personal assets are assets like home, land, the financial security, jewelry, artwork, gold, silver, your checking account. All these things are personal account. And business assets are owned by the business. Okay, though they could be the motor vehicles, the buildings, machinery, equipment, the cash, accounts receivable. All these things are business assets. Now what accounts receivable is, we will touch upon in another video, but I hope the other examples are clear to you, right? The business assets. Yeah, and then the non-physical or intangible assets. Yeah, so this we had. Okay, so what is considered an asset, right? We already talked about this a little while earlier, correct? But let's recap it once again. So, when looking at an asset's definition, we find that it is something that provides a current, future, or a potential economic benefit, right, for the individual or the company. So, therefore, asset is something that is owned by us or something that is owed to us. Okay, either it is owned by us or it is controlled by us as well, right? Owned or controlled by us, or it is something that is owed to us. Okay, so suppose say we give some amount of money to a friend. Okay, we lent them that money, then that friend actually owes us that money, right? Therefore, in this transaction, actually the money that we gave is actually an asset to us because we are liable to get it back. Yeah, so a 2000 rupees bill or a desktop computer, a chair, a car, all these things are assets. Now, if you loaned money to someone, that loan is also an asset because you are owed that amount. But for the person who owes it, okay, so for your friend, it is a liability. Now, what is this liability? Earlier also we asked whether the car will be an asset to you or a liability to you. Even now we are talking about liability, right? If I lend money to my friend, then that amount of money is an asset to me but a liability to my friend. So what is this liability? Well, liability is something the person or the company owes, okay? And generally when we talk about liability, we think of it as usually a sum of money, okay? So this is the important term over here. It is owed, okay? Liabilities are settled over time through transfer of these economic benefits, including money, good, or services. Okay, and liabilities are generally recorded on the right side of the balance sheet. Okay, and assets are recorded on the left side. Okay, so liabilities include like loans, accounts payable, mortgages, deferred revenue bonds, warranty, accrued expenses. All these things are liabilities. Okay, and liabilities are actually kind of like the opposite of assets. Okay, because they refer to things that you owe. Okay, or you can say you have borrowed. Okay, but whereas assets are things that you own. Okay, or you are owed. So, even in liabilities, we have different types of liabilities, like the current or near term liability, which is a short term financial obligation that is due within 1 year, okay, or within the normal operating cycle, like payroll expense, accounts payable, which include money owed to vendors, monthly utilities, and such expenses, okay, wages payable, interest payable, dividends payable, unearned revenue, all these things are current liabilities. Like if you employ 10 people in your organization, at the end of every month you are liable to pay the employees their salary, right? If you have taken your office building for rent, at the end of the month or maybe at the beginning of every year, you are liable to pay that rent, right? If you have accepted deposit from somebody, then you are liable to pay them the interest in the appropriate interest cycle, right? Maybe it is monthly, it might be quarterly, it could even be daily or at the time of maturity. Whatever it is, you are liable. So all these things are liabilities to you. Mm. And non-current or long-term liabilities are not so near term, right? So it can be paid in 12 months or more. Okay, like bond, rent, deferred taxes, payroll, pension obligations, warranty liability, all these things are different types of liabilities. Coming to the last concept, that is capital. Okay, what is capital? Capital, when we start a business, we say that we need some capital, right? A business uh, functions, or the business is set up with some amount of capital, right? So capital is actually a very broad term, and it can describe anything that confers value, okay, or benefits to its owners, such as a factory, its machinery, intellectual properties like patents, financial assets. Okay, all these things are capitals. For us, let's say if it is for an individual, our personal savings are our capital. Okay, if we want to start something, okay, if we want to buy something, then our personal saving is our capital, right? Friends and family, okay, angel investors, private loans, corporations, venture capitalists, federal, state or local governments, work or business operations. Okay, when you go public with an IPO, the money you amass, it is actually capital. Okay, so all these things are capitals. Now when we are budgeting, businesses of all kinds typically focus on three main types of capital. Okay, that is working capital, equity capital, and debt capital. And a business in the financial industry also identifies a trading capital. Okay, now let us quickly look at what these different types of capitals are. Hmm? Debt capital is when a business acquire capital by borrowing. Okay, suppose you take a loan from a bank or a government source, okay, or from some lender, okay, then and use that money to set up your business. Okay, then that is a debt capital. Okay, now just like individuals, if we go and approach a bank to get some loan, okay, maybe it is a personal loan or maybe it is an educational loan, they look at our credit history to determine whether or not we uh, uh, we can be given that loan, right? Similarly, even for a business, they look at the active credit history. Okay, so that is debt capital. Next is the equity capital. Okay, so equity capital, uh, it is in contrast with the debt capital. Okay, suppose let's say the company is going public. Okay, they are listing themselves in NSE or BSE. Okay, then what happens is that um, they sell their shares, right? They sell their shares to potential shareholders, right? Through IPO and all, and from that sale of the share, they get money, right? They get the capital. Such a capital is actually what is being understood as equity capital. Okay, so that is what is equity capital. So when an investor buys certain number of stocks belonging to a company, that investor would be paying that money, right, to that company to get that stock, correct? So that money which the company is getting, that capital is termed as equity capital. So debt capital came from borrowing, whereas equity capital came from sale of equity. Okay, that is shares, bonds, something like that. Okay, Next is the working capital. Okay, so working capital is nothing but just like a liquid capital. Okay, so it is the amount of money that organization will have with itself to fulfill all the day-to-day operations, right? Kind of like a petty cash, like they will have some amount of money always with them, with which they will be able to smoothly run all the day-to-day operations. Not the salary or the rent or anything like that, but maybe buying a stationery or some what you can say, some travel reimbursements or something of that sort, right? Simple daily day-to-day activities. That is working capital. Okay, and then yeah, the trading capital is usually done is usually the capital which is held by the hedge funds, like not hedge funds, the traders. Okay, the big traders like hedge equities and all, right? They have trading capital. So that is the capital, okay, which they have to involve in large number of trades, okay, daily trades. That is trading capital. Okay, so uh, as for this particular MBA, MMPC 4, it is not necessary that you understand or you by heart all these different types of assets or different types of liabilities or different types of capital. It is not necessary, but you should understand what exactly do you mean by asset, liability and capital. That is very important. Okay, the classification of different types of assets, their names, or liabilities, or the four types of capital, that is not very important to us. But the crucial part is when we look at a financial transaction, we should be able to identify what is the asset, what is the liability, and what is the capital. Okay, that is what is important. So you should have an idea, a clear idea of what an asset is. You should be able to identify an asset from a liability or a capital. Okay, so that is something that you have to look forward to. Okay, so just a quick example. Okay, we say that every organization functions with its employees, right? So is an employee or a labor an asset, capital, or liability? Okay, now what is an asset? Asset is something that is owned by you, or it is something that is owed to you. What is a liability? Liability is something that you owe, or you have borrowed. What is a capital? It is something that confers value or benefit to its owners. Correct? Now, an employee. Do you own an employee? If you are running a business organization, I know many people consider employees or their time as something that is owned to them, right? Especially in right now, there is a lot of talk going on about moonlighting, dual employment, all those things, right? So it is kind of like the big corporations or even any business organization, they kind of think that they own their employees or own their time, they bind them with all these contracts. But do you actually believe that an employee is owned by the organization? We are not slaves anymore, right? We have come a long way from the slavery era, right? So we are not owned by the company that gives us the salary, right? We are not owned by the corporation we work for. So definitely you should not be considering your employee as your asset. Okay, naturally you are liable to pay them salary. The employees are they are, you are liable to pay them their salaries, right? Or their medical expenses, whatever it is, you are liable. So are employees a liability to you? Well, definitely having an employee means you will need to pay for their taxes, you will need to pay them salary. But without an employee, will your business be able to function as smoothly as with an employee? No, right? So employee is not an expense, correct? It is the what you can say, it is the reason that you have a revenue, correct? So definitely you cannot think of employees as liability. So the only thing remaining is capital. So definitely yes, employees do confer value or benefit to the organization, right? So therefore at best you can think of your employees as your capital. You should not be thinking of your employees as assets or liabilities, right? It is human capital. And human resource management is nowadays more and more being coming to be known as human capital management as well. Why? Because employees or these business organizations are slowly but steadily recognizing that the humans in their organization are not simply resources. Okay, resources are assets, they're not simply resources, they are the capital. Okay, you might have what you can say, you might have come across a lot of employees or a lot of people talking about employers talking about employees as assets to the organization, but that is wrong. they do not own us. It is very wrong to say that employees are assets. Employees are capital. Okay, so one more quick concept and then we'll wind up this topic. Okay, that is owners or stockholders equity. Okay, so if a business subtracts its liabilities, okay, from its assets, then whatever is remaining, that is called the owners or stockholders equity. Okay, so assets are things that are owned by the organization which have a value. Liabilities are something that the organization is bound to give back. Okay, and the difference between that asset and liability, you will get some amount, right? That is the owner's equity. Okay, so equity typically refers to the shareholders equity. Okay, that is or owner's equity for privately held companies. It represents the amount of money that will be returned to a company's shareholders if all the assets were liquidated and all of the company's debts was paid off in the case of liquidation. Okay, so in the case of acquisition, it is the value of the company sales minus any liabilities that is owned by the company but is not transferred with the sale. Okay, so it actually represents the owner's investment, that is capital, in the trade minus the owner's withdrawal from the trade, that is drawings, plus the net income since the business concerned commenced. Okay, so suppose say I've bought machinery worth 1 lakh. Okay, and I've also have a loan worth 90,000. Okay, to be paid back to the let's say to the bank. Okay, so then that 1 lakh minus 90,000, 10,000 rupees is what I will get in case I decide to liquidate my company, right? That is, I'll sell off the assets, I'll get 1 lakh rupees, then I'll pay back the bank loan. That will take away 90,000 rupees from my pocket, and whatever I'll get back is only 10,000 rupees, and that is what is owner's equity. Okay, so I hope these concepts, what we discussed in this video, you are clear with these, right? Especially the three pillars, that is assets, liabilities, and capital. From these three topics or from these three concepts only, all the other concepts, even owner's equity that we saw just now, gets built up. Okay, so in case it is not clear, see this video once again. Okay, go through the material. Okay, and try to grasp the concept. If still it is not clear, leave a comment below wherever you're finding difficulty. I'll definitely get back to you. Okay, either through comments or through a video, so that I'll explain it more. But let me repeat it more and more, especially if you're coming from a non-commerce background. These concepts would be a little bit difficult to wrap your head around, but do try it. Once you understand it, it is very easy moving forward. Okay, so thank you so much, and I hope this video helped you, right? If it did, consider subscribing, consider telling your friends about us. Okay, let us grow our community so that we all can help each other and become best or very good, better managers of tomorrow. Do leave a thumbs up if you like this video. If you have any suggestions for any topics which you need covered, leave it in the comments. I'll definitely consider making a video on this at earliest. Okay, so thank you so much. Catch you in the next video.